What's happening, Hardscapers? This is episode 90 of the How to Hardscape podcast, where we talk to you about how you can start and grow your hardscaping business. And today we have back-to-back episodes on personal finance, one specifically for personal finance for Canadians, one specifically personal finance for Americans. But within these two episodes are excellent advice on personal finance in general, as well as some business finance mixed in there. So I strongly urge you, regardless of where you are in the world, regardless of where you're listening to this, listen to both of these because there's excellent advice in each of them. And in this episode, we are joined by Kirk Chisholm. He is a principal wealth manager at Innovative Advisory Group, located in Lexington, Massachusetts, and he is also one of the hosts of the Money Tree Investing podcast. He joins us today to talk with us about personal finance for contractors and offers so much more advice on top of that. So without further ado, here's our interview with Kirk Chisholm. Today, we're joined by Kirk Chisholm. He is a principal wealth manager at Innovative Advisory Group located in Lexington, Massachusetts. And he has been providing financial advice to individuals and families since 1999. And he is also the host of the Money Tree Investing podcast. He joins us today to give us advice about personal finance as contractors to set us up for success financially in our personal lives outside of our business. Kirk, thank you so much for joining us.
Yeah, thanks for having me on, Michael.
Kirk, let's get started to get to know a little bit more about yourself, how you got into this industry and giving guidance for financial advice to individuals and families.
Yeah, so it's interesting. So I've actually been really interested in this field since I was young. When I was in college, it was the late 90s, which of course, everything was interesting back then because the markets just pretty much went straight up every single day. So it was very interesting when I was younger. So I actually interned at a lot of different firms when I was in college. And when I graduated, I got started at Payne Weber. I was licensed to start in December of 1999. So pretty much missed all of the whole bull market and started right at the top. And I think one of the, as much of a struggle as that was for the next 3 years to try to eke out a living because the market pretty much went straight down, what that really did is it taught me the value of risk management. And, that's probably one of the things that is one of the most important things that people can do, whether it's investing, whether it's in business, whether it's in life. I mean, risk management first is one of our core philosophies. So that really, all of that was colored by my initial experience. And I think, I think about people who'd been in the business for 10 years prior to me and things always went well and they struggled when things went poorly. And so I think it kind of gave me a better sense of resilience, being anti-fragile, all the things people talk about. So I find that to be a really important part. And subsequently, after working at Payne Weber, which was bought out by UBS, then I went to Smith Barney, went to Royal Alliance, and started my own shop in 2008 as an independent RIA, because we really just wanted to be able to, provide unbiased advice as fiduciaries to our clients, and really just kind of have a upfront and clean relationship. And it's been great. It's been a great experience. So yeah, it's been a lot of fun.
And a very interesting year to then again start your own business. 2008, I'm sure brought about some interesting times for you starting out there.
Yeah, it's, when we started, like I mentioned, market pretty much went down for 3 years. And I learned pretty quickly how to manage risk because I had to, because the market just kept going down. 2008 was obviously a very different time period. And so in 2007, we actually, in August 2007, with a lot of my clients, we went completely to cash because, I saw the writing on the wall and I knew that things were not going to be great. Didn't know what that outcome would look like, but I knew it wasn't going to be good, at least everything I was hearing and reading. So we went entirely to cash. So we missed all of 2008 and the beginning part of 2009. So it was great because we didn't have to worry about, losing 58% of our clients' money like what the market did. And it was a challenging time in many ways because even when the market was going up, no one knew if the system was solvent. So it was a very challenging time for people who didn't go through it. But we did pretty well. And we started the firm during that time, really with the idea that before we started the firm, we had the idea to start it, which was really to look at opportunities outside of the stock market, because there's so many opportunities out there that people can invest in that have absolutely nothing to do with stocks, bonds, and mutual funds. A good example might be like rental property or tax liens or private mortgages or private company stock, fishing rights, airspace rights. I mean, you name it. Think in Canada, there's something called Crown Land. There's all these different niches that people invest in that you can get some really good returns in if you know what you're doing, but they're not in the stock market. So we wanted to be able to do that inside of a retirement account, which most people aren't even aware that you can do. I'll give you a good example. I've talked to a lot of real estate investors, and what they'll tell me is, I'll talk to them and say, "What are you doing for retirement?" And they say, "Oh, I don't invest in retirement accounts. I put all my money into real estate." And I look at them and I'm like, "Okay, I get it. Great tax benefits, but what if you do both?" And they look at me funny. And they're like, "Well, I never had a 401k because I just didn't want to put it into mutual funds." I said, "I know, but you don't have to. You can invest in anything, virtually anything. There's a few exceptions, but generally you can invest in virtually anything." And they had no idea because no one's told them that. And it's this interesting space that we've kind of carved out for ourselves that, we're experts in, that we can really help people invest in what they know, as Peter Lynch used to say.
Is this something that people have to come to you to be able to work out what they can, say, put into a retirement account and to get that tax advantage?
No, they certainly don't need to come to us. They can do it themselves. I don't usually advise people do that, not because we want more business, but because we're one of the few, if not the only firm. Well, we're the only firm that I know that markets this. There's a few other firms that do this, but they don't market it in this expertise in the self-directed IRA space. The challenge is there's a lot of complexity to it. If you're looking at a really simple example of an investment, it's not that bad, but you get into this complexity, it gets really challenging, and there's a lot of questions. There's things that to this day I'm still learning. And I do this, full time, just professionally. We're experts. And you come up with these new assets you've never dealt with before, and there's these different angles that you haven't encountered. So you have to, we read the tax code a lot. We look at tax court cases. We're talking to attorneys that specialize in the area. Like it's not like you buy one stock, you've done it before, right? Like every asset is different, every situation's different, and you really need to be able to analyze things on a deeper level, which we have a lot of capability to do. Most people don't really have that capability because it's not. It requires a specialty that it's just going to take some time to understand.
Yeah, drawing a parallel to our industry, like a homeowner can put in a patio, but it might not be the same as a professional, right? I guess that would be the same as you guys. Somebody could try to DIY it, but you're dealing with the tax code, you're dealing with lots of money. Might as well go to the professional that knows what they're doing, who that's done this before, and that can put in the work to understand what they're doing.
Yeah, I totally agree. I mean, that's why, professionals have jobs. It's not. I mean, there's plenty of DIYers out there, and that's great. They're not our clients. We don't want DIY clients because, look, I'm a DIY client. I'm a terrible client for somebody because I'm going to nitpick them. I'm going to want to do it myself. It's just how I'm built. And, when it comes to building a house, I'm not building a house, but if it's something that I know and I'm interested in, I want to do it myself. And I think they're not the ideal clients, but there are so many people out there who don't have the time. They don't have the expertise. They just need someone else to do it. And, and some of these people are really, really bright people. It has nothing to do with the level of intellect. It has to do with the desire to do it yourself. I mean, we work with a lot of smart people. I mean, good example. I mean, look at some people who've done this publicly, like Mitt Romney as publicly. He's got an IRA worth over $100 million. Peter Thiel, Max Levchin, there's a few others that have these really enormous IRAs. The 314 largest IRAs in the U.S. have an average balance of $257 million. So you can imagine what the largest one looks like. And there are a lot of things that people can do. And most of those have experts that they work with. Not necessarily me, but there are plenty of people who work with very large IRAs, many of which I know. And, they work with these people and they need professional help because you're getting into areas that are not just cut and dry. They're areas that you need a professional opinion. You might need a tax letter ruling. However, that's different because you're talking about $100 million. Paying for a tax letter is not such a big deal. But for you and I, we work in areas that are a little more simple, and we can afford to find good investments that aren't necessarily plain vanilla, but that do make good returns.
Absolutely. I like that you mentioned, early on in your career, you learned about risk management, and that came into play again in 2008 when you started your own business. Can you describe for us what risk management means and what it means to manage risk? Because that's a great topic to get into for personal finance as well as, owning your own business, right?
Yeah, that's a great point. So risk management is something that we're all naturally wired to do, but I kind of think of it as kind of like the pleasure versus pain conversation. Risk management is avoiding pain versus seeking pleasure. Those are two very different aspects of human nature. And you think about like a casino, right? You go to the casino, you want to spend lots of money, you want to make money. You go there to make money. You're not going there not to lose, you're going there to win. And and a lot of people invest in the stock market because they want to make money, not because they want to preserve their wealth, but more because they want to make lots of money. So it's a very different aspect of that. So we look at risk management, our philosophy is risk management first. And we look at risk management as, in its simplest forms, is identifying all of the risks, mitigating as many as possible, and then the last step is being comfortable with what's left over. Because there's always going to be risks. If you invest in a U.S. Treasury bond or bill or U.S. Treasury, you could look at that and say there's no risk. And I would say there's almost no risk. It is what a lot of people call the risk-free rate. So it's as close to risk-free as you can get, but it's not risk-free. There's plenty of risks if you're investing in treasuries and interest rate risk. And the U.S. government could default. They won't, for so many reasons, but they could. And that is a risk, just like, investing in a CD in the bank is FDIC insured. And you say, well, there's no risk. Well, I'd say, no, there are risks. Look back in 2008. If you were in a bank that went bankrupt, you got your money back eventually. So what if you don't get your money back for a year? That's a risk. What if you need that money? What if that money was meant for something and now you don't have access? What if you're retired and you need money? So there's always risks, and risks are fine. Risks are not a problem. It's just understanding what they are and understanding what you're comfortable with are really important points. So when we look at risk management, we look at it, my business partner characterizes like playing 3D chess. Because you're not just answering questions and saying, all right, these are the answers, we'll be fine. It's, asking a question, then asking 3 sub-questions, needing more information to substantiate certain things, asking other questions that are related. And, oh, by the way, you just mentioned that you referenced this document. Well, where is that document? Now I got to read that document. So it's really a lot more complexity than people realize. And, I'm sure people listening to this are probably hitting the snooze button because it sounds boring, but it's not fun. Like, I don't enjoy reading documents, but I can tell you that going through those processes has saved me so much money over my career, just reading simple things. And I'll give you an example. Back in, I think it was 2017, there's this thing called the VIX, which is basically a volatility index in the stock market. And it basically measures, in simple terms, it kind of measures the probability of risk in the market. So the higher the number, the more risk there is, the lower the number, the less risk. That's how it's supposed to be measured. Now, one day it just kind of went from a very low number to an extremely high number almost overnight. And there was this investment product, there are multiple, but we'll say there's one, which I won't name, that claimed to be very conservative, meaning there's very little risk, and the fund went to zero because it didn't understand the risks it was taking. And if it did understand it, it didn't clearly accentuate it to people. However, I will say that there was a running joke about this fund months prior to this, where people were passing around the prospectus and saying, yeah, it says in the prospectus, this fund could go to zero. Nobody reads the prospectuses. And even if they did, they probably wouldn't have understood what that meant, because prospectuses just many times will just lay out every risk and they'll just say, well, I have to put it in there. But people didn't truly understand what they were investing in. And some people lost a lot of money. I mean, I heard stories of people losing. A friend of mine was telling me this story about this guy who retired, put all of his money into this thing because it was earning good returns, and then just lost it. I mean, he sold his real estate property, put it into this thing, and just lost it. And I mean, it's so sad. This guy, I mean, he still has some money, but his retirement is going to be so much worse than it would have been before because he didn't do his own due diligence.
I love this stuff. So you could talk forever on this stuff, and I would listen. I eat it up, and you part of my interest into personal finance came from listening to the Money Tree investing podcast, and I know that you are now one of those hosts. So thank you for helping people to understand personal finance more, to help them get into investing into their future and what that means for them in their future. So I do want to get into, not just kind of the basics, but at least starting something as business owners to put aside, to diversify, to take advantage of these tax advantage accounts. So can you start with where we should start if we are living in the States? Where should we start when it comes to investing personally outside of our business?
Well, I think you make a good point, because the question is whether you invest outside your business or in your business. So there's multiple paths, I would say, here. So first is, if you're investing, there's multiple things that come into play. There's how you position the investments, there's potential cash flow that's generated from the investments, and then there's kind of like the tax side of it. So no matter what you invest in, you have to understand the tax side of it. So one thing in the States that people can do is they can set up a retirement plan, and that's dependent upon the business. So if you're a solopreneur, as people call them, you're just a one-person shop, or you have contractors but you don't have any employees. There's a lot you can do for yourself. You could set up an IRA, which you can put up to. I think the rules this year, the IRA limits are $7,000 in 2021. It's it's $6,000 if you're younger than 50, it's $7,000 if you're over 50, if you include the catch up. And then you can also that's per person, and that's per year. So you can put that $6,000 up in your IRA for last year up until April 15th, and you can also put in this year. So that's a way to put in $12,000 right away for you, and then if you're married, you can put another 12 for your spouse. So that right there is a good chunk of money that you can put away tax deferred. If you use a Roth IRA, it can be tax free. We could get in the weeds here, but I'm just giving you kind of the high level overview. And then if you have a business, you could set up a 401k plan or defined benefit, depending on how much you want to put away. And you could put up to a lot more. I mean, if you're over 50, you can put up to $63,500 for last year. This year, it's $64,500 for 2021. So you can put away a lot of money. And if you need to put away more, there's other things you can do. But the point being is this is money you can put away every single year. It reduces your taxable income now. You'll have to pay taxes on it when you take it out. But if it's a pre-tax contribution, you're basically deferring taxes much, much later. And then, so let's say you put in 50,000 and that grows at a certain percentage, let's say 5% hypothetically, that's going to compound pre-tax. So you're not going to pay any tax until you take the money out. So that allows your money to grow faster. And it's a great part of the tax code that people should be taking advantage of. And I don't care if you're a real estate investor and you don't want to invest in mutual funds, that doesn't matter. You can invest in whatever you want virtually inside your IRA. So you should be taking advantage of that. That's a really great way to invest. If you have a way that you're an expert in. Let's say you're fixing flipping properties, or you're investing in airspace rights, or whatever your niche is that you're really good at. Think of the returns you're getting in that. What are the returns? Are the returns 5%? Are they 10? Are they 50%? I mean, I've seen some people making 40 to 80% a year in areas that they know really well, and like fishing rights. So there's, I wouldn't go do that because I'm not an expert in it, but I know people that do this for a living. They should be taking advantage of that. So I think of things like that, and I say, you should invest in what you know if the returns are decent. If you don't have any areas that you're investing in, that's fine. That's why people invest in the stock market, is finding other areas. And if you're doing that, I would highly suggest using a professional. I would say it's hard to find a good professional, just from experience. But if you don't know what you're doing, some people will index. They call it indexing, and I'm sure there's some simple ways that people can figure out how to do that. But in general, the stock market's tough if you don't know what you're doing, and even if you kind of know what you're doing, it's a rough place. You look at recently all the people that made and lost lots of money in some of these stocks that were highly shorted through Robinhood. Probably heard about that. I mean, that's basically Wall Street being Wall Street. People made a lot of money and they lost a lot of money. And, you get what you pay for. If you're going to gamble, then sometimes you win, sometimes you lose. But I think if people take kind of a methodical approach, find good investments, invest for long-term strategy, dollar cost average, there are some best practices there that work out well. But I think it's important that, we talk about in the show a lot, got to do your own research and invest in yourself. That's really important.
Some great advice there. Now, when you talk about being an expert in something, say I am a landscape contractor, but I'm an expert I want to build that expertise in flipping houses. If I'm going to put that into a tax advantage account, does that have to be a side kind of project passion? That can't be a business, right? Or can that be a business that how does that kind of work?
Yeah, that really gets into the weeds. So if you're, you have to really be careful, because you cannot do business with yourself, meaning your IRA cannot do business with you. So for instance, if you own a rental property, you cannot rent that property to a disqualified person. Disqualified person would be yourself, your spouse, your kids, grandkids, your parents, grandparents, great grandparents. It's just lineal descendants and ascendants. And you could do business with your brother or sister, cousins, things like that. But there's some very clear rules of who you can and can't do business with. That also means you can't fix the roof or the toilet if it breaks. You can hire people to do that. You just can't do it yourself. So there's this thing they call sweat equity that you cannot contribute to. And in part because there's no way to value that. So the IRS just says you can't, because they would say, well, how do you value that? Are you charging yourself too much or too little to do the work? Or you can't do it for free. So it's things like that that are really interesting when you kind of think about it. But so to get back to your point, fix and flip can be considered a little bit more of an active activity. And if you're doing it yourself, then that's probably not going to be allowed. So, this is why all the nuance is important, is because there are rules, and then there are exceptions to those rules, and then there's exceptions to those exceptions, and you need to understand. And by the way, your TD, Schwab, Fidelity, your accounts there, they have all the same rules. You just don't see them, because with securities they make it really easy. But if you're investing in a business or rental property, there's more complexity, because you have to read the documents. Certain people have to sign them. There's a lot of little nuances in the process that if you don't understand them, you can really get yourself into trouble.
Would a similarity to this rule kind of be like if you were investing in the stock market in a tax advantage account, but you were day trading, which could be misconstrued as a profession or as your business? Would that be a similarity to draw there?
Yeah, it's interesting because they have this rule if you're a trader business, right? So if you're flipping a lot of houses, or if you're a day trader, you could technically fall under a different taxing category And some people want to do this and some people don't, but you should understand it, because if you inadvertently do that and you don't understand your tax consequences, you could really mess things up from a tax wise. Most people do not want to get into a real estate trading business if they can help it. If they, at least from my experience, there's nothing wrong with it. It's just, if you're doing 2 or 3 properties a year, you prefer to stay out of it. If you're doing 100, then it doesn't really matter. But if that's so, I think there's some nuance there as well, as you accurately point out.
Our audience, I guess, would be contractors that probably have their hands full right now operating their business. So would you say the best way to go about it for them, if they don't want to get their hands on investing so much and investing a lot of time into this, to say open up a tax advantage account and start indexing? Would that be like kind of a way that you would kind of direct them if they're not looking for that professional advice?
Yeah, it's hard because I can't really give advice into a vacuum, because everyone's different. So people should understand that everyone's different, and that what your neighbor is doing, what your friends are doing, even if they're claiming they're successful, kind of like when you go to the casino and people only tell you about their wins, your friends are going to do the same thing. So don't listen to your friend's advice unless they're a professional. What I would say is, the way to think about it is, you have to there's a lot of kind of rules of thumb on Wall Street, and you have to incorporate a lot of them and understand how they work to be successful. So people index because they don't know what they're doing. And it's not, you'd never see like Warren Buffett indexing, because people who know what they're doing would never do that. But I'm conflicted because, I get this question a lot from friends. Like, I don't work with friends because it changes the relationship. For an example, the way I think of it is, I don't work with friends. So all my clients are friends, but I don't turn my friends into clients, just because it changed the relationship. So if the market dropped 30% and somehow we weren't, prepared for it, my friends are getting pissed at me, and now it's all about the investments and not about the friendship. So I just draw the line. I mean, I don't. So I would say it's a hard question, because I get it a lot. Like, what should I do with my money if I'm doing it myself? And if you're younger, you can index because you've got time to make it back up. But I think everybody should be managing the risk if they know how to do it, because if you can do that and you're not losing money, that's the biggest path to wealth, is not losing it. That's really one of the big keys.
Kirk, getting into owning a business and deciding what you're doing personally with your finances, obviously growing a business, putting money back into the business can typically bring us more, depends on a lot of different factors, I guess. But we can look at our business and say, well, might as well put the money there, as opposed to putting it into the stock market or into these other investments. And I'll make more money in my business if I just, invest the money into there. Where do you draw that line between personal and business investing, and kind of try to separate those two? Is it diversification? Is that the word that you would use if you're telling somebody to, hey, let's put that money into this investment as opposed to your business, to diversify? What is that?
It depends on your tolerance for risk. It's a really good question, because a lot of entrepreneurs will dump every nickel they have into the business, and then the business will fail, and then they're SOL. And I think what happens, a lot of people go into businesses unprepared. I usually tell people, like, plan out your expenses of what you think it's going to cost for the next year, and then triple it. Because really, whatever your expenses are, you're going to have no idea. Stuff's going to come up. You're going to have things you're going to need. So, most people, let's just say they think their expenses are going to be like, I don't know, like 100,000 a year. Say plan on 300,000, and you'll probably be closer to the mark. So, I think when you're looking at investing in a business, it depends on the kind of business you have. But most businesses, legitimate businesses, you can figure out what your return is. So I'll give you an example. Let's say you have a widget that you're selling for like $5, and you can make it for $1. You go on Google and you advertise, and it costs you $2 to advertise that. So it costs you $1 to make, costs you $2 to advertise. That's $3, and you can sell it for $5. So effectively, you're getting, $2 for every three that you spend, right? That's your return, right? Or probably I should have used better numbers, but let's say it's $2. You're spending $2 and you're getting $2 back, right? So you're getting 100% return on your money. So if you're able to, so the way I would look at it is if my return is in my business is 30%, which I think is a reasonable number for most businesses, then why would I invest in the stock market? If I could invest more money into my business and generate 30%, why wouldn't I just do that? So that's more from the mathematical standpoint of looking at it from return based on investment. And some businesses are literally that simple. The more money you put in, the more money you'll churn out within reason. In some businesses, it doesn't matter. There's no capital need. You might be selling a course, like an online course. So once you set up the course, putting more money into it is not going to help unless you have advertising dollars. That obviously you could spend some there and make some back. But I think it just depends on what the need is, what the capital need is. But people should be thinking about that aspect, and then they should be thinking about, what is where are my best returns? And I don't mean finding like cryptocurrencies you're getting hundreds of percent a year. I mean, like, where are my best opportunities? Because you're comparing three investments, your business at 30%, the stock market at, let's say, 10% hypothetically, and let's say a CD at 2%. Well, where are you going to put your money, right? Where is it treated best? Now, maybe you want to put it in the CD because you want to keep it liquid for something else, or maybe you want to invest in your business because you need it. Or so there's a lot that goes into the decision-making process. But I think the way people have to think about it is like, analyze their numbers, analyze your returns, analyze the need. Don't just make a snap decision because it feels good, but actually sit down and work on the numbers.
Definitely. And I like the word that keeps on coming up throughout this is risk management, knowing your risk. I think that's such an important thing to bring up and to kind of close things out here with one last question. Debt and taking on debt as a business owner is a big thing. If, where's that line where you say you don't have the capital right now, but you can take on debt that's, say, this amount, and or even if you have the money on hand and the debt that you can take on is less percentage than what you would get if you put that money in the stock market, hypothetically, or put that money in your business. Where do you stand on it in terms of, or what advice would you give in terms of taking on debt as a business owner, and anything that you could really talk about in terms of risk, debt, and your opinion on it?
Yeah, debt's a good topic. So debt is, you get people on both sides of this. You get people that are very anti-debt. They said there's absolutely no debt you should ever have, and they're very anti-debt. And I think philosophically, I think I can see their point, right? I mean, debt is it can be a very bad thing. It's I call it a double-edged sword, because when things are going in a direction, it gives you leverage, and when they're not going in a direction, it gives you reverse leverage. So it really can cut both ways with debt. I think that's an extremist view of saying no debt ever. But you take the other side of it, where people go way into debt. You take like 2000 and prior to 2008, where people were taking out ninja loans and putting zero money down and buying 20 houses with no equity. I mean, that's great if you can flip them, but at the end of the day, that's just poor risk management. So I think debt is something that you really need to understand what you're doing. If you're taking out debt to put money on your credit card, that's just dumb. And I don't mean dumb and like the person's dumb. I mean, like, you're not effectively using your debt. I mean, I get we all have credit cards. It's the way, I mean, I use them too. But if you're carrying debt for the sake of consumer spending, that is not smart. If you're carrying debt to expand your business, to pay employees that you need to expand, to buy goods and services to expand for your business, and that debt is going to turn into a higher output, that is positive debt. That's debt that's being positively used. And, you borrow $1 million and that allows your business to expand threefold. Well, that's a good use of capital. Yes, debt is great. And rates are so low, it's hard. It's like free money. So from that perspective, debt's really good because you're using it for positive reasons. But if you're using it personal, it's really not positive. It's not going to create more, because basically positive debt creates more income, creates more revenues, creates more profits. Consumer debt is just, and I'll simplify this. We call it pulling revenue forward. So if you think about it this way, if you're making $100,000 a year and you're spending 150,000, well, you're putting up 50,000 worth of debt, and that has to go somewhere. Well, eventually you've got to pay that back, which means at some point in time you've got to make 150,000 plus that extra, some amount of that extra 50,000 that you took out just to pay it back. So, at some point we can't take on more debt. So at some point you max that out, and that means you've got to kind of figure out the numbers and say, all right, we got to either file for bankruptcy or find ways to write it off or earn more or whatever the outcome is, because there are limits in terms of what you can borrow. So I think that's a really important concept people should understand.
I don't even know if this is a relevant question because it's going to change between industry and industry, market, whatever. But is there a debt to revenue ratio in a business that you would say, you're in a good situation if it's looking like this, or is that even a question that is relevant because, every industry is going to be really different?
It's a good question, but it's highly dependent upon the industry.
Right.
And, if you think about, let's think about digital products. You're putting together a course and you're selling that course versus someone who's buying and flipping homes. I mean, it's different. The numbers are very different. So I think you need to understand what that is in your industry, and you need to understand how that feels with your cash flow. Because if you're just taking on debt so you can increase your cash flow, but then you're basically covering your debt payments, well, what good is that? Right? There has to be kind of a positive outcome there in terms of where this can go. So I think it depends on the industry, and if you're not sure, ask around, ask your accountants, talk to other people in the industry, ask trade groups, they'll tell you. I mean, all this data exists. It's just a matter of just spending the time to figure it out.
Definitely. Kirk, thank you so much for your time here. Is there anything else that you want to touch on that we haven't in terms of personal finance, maybe specifically for contractors? I know a word that came up often here was risk management. I love that. I love thinking about that in planning my business for the future in regards to risk management and carrying that forward. Anything else that you want to speak on before we close things out here?
No, I think you did a great job of touching on a lot of the big topics. I mean, if somebody's starting their own business, I would say get the advice of professionals. Talk to your accountant. And a lot of people do their own taxes because it's cheaper. Talk to your accountant. If you're running a business, if you have a good accountant, there's many things they can do to save you money. Even if it's just changing the type of company, sometimes can save thousands of dollars for people. So, just spend the time early. Make sure you get the right partners, collaborative partners on your team. Make sure you have a good accountant. Make sure you have a good advisor, good attorney. Just make sure you have a collaborative team that you can work with so that you're not making the mistakes that a lot of people make. And most people just jump in with both feet, which is great. But, there is a lot of work that has to be done. And nowadays, governments are so heavily focused on regulating everybody that I can almost guarantee you that, at least half the population is out of compliance just in the sake that they don't know where all the rules are. I mean, our industry alone, we're hyper compliant, and we have somebody internally who deals with that. And he's asking all the hard questions. I don't know many other people that are asking those questions. I can assure you most people are out of compliance just because they don't know. The rules change all the time. Like they change the rule and we call them and say, hey, what did you mean by this? And they're like, oh, that's not, because we think it means one thing. And they're like, no, it doesn't mean that. It means this. Like, okay, well, a lot of people are going to think it means that, so you're going to cause some problems. So, so it's that kind of thinking. So as they incorporate more rules, you almost need everybody needs an internal compliance officer just to keep up with the rules, so they're not getting themselves into trouble. That's an easy fix just by finding the right collaborative partners, CPA, advisor, attorney that understand the rules, and just having periodic conversations with them, just saying, here's here's what I need to know. If you don't have the answer, who can you point me to that does? So we do a lot of that. We advise a lot of small to mid-sized businesses, because there's a lot of rules, and in terms of just operations, marketing, expansion, all of it, we just we get really involved with our clients because we want them to succeed.
Incredible. Kirk, thank you so much for your time and sharing your knowledge here. I really do appreciate it. I do appreciate listening to the Money Tree Investing podcast and everything that you all share over there. Where can we find out more about yourself, your business, and the podcast itself?
Yeah. Thanks, Michael. So I mean, I'm pretty easy to find if you go on social media. You can find me on all the major hangouts: Twitter, Facebook, LinkedIn. The easiest place to find me is our company website, which is innovativewealth.com. If you go there, I've written all the blog posts, all the content on the site's written by me. So if you really want to get to know me, that's the best place to learn about, what I believe and how I think about things. And of course, you can find me on Money Tree Podcast every week. Our episodes come out on Friday, and that's just moneytreepodcast.com. It's on all the major channels, iTunes, Spotify, Stitcher, Google Play. We just talk about a lot about investing, personal finance, a lot of the things we talked about in the show. I thought this was a great interview, Michael. You did a fantastic job. And I really enjoyed being here.
Thank you for listening to today's podcast episode. Visit us at howtohardscape.com for more information on this subject. Let us know what you want to learn about in future episodes by reaching out to us on our social channels. We are at howtohardscape on Instagram and Facebook, or you can send us an email, contact@howtohardscape.com. We'd love it if you subscribe to this podcast, left us a rating review if you are using Apple. This really helps us get this podcast out there into more people's ears and to attract great guests that we have on the show to deliver you more value. We look forward to meeting with you next week on the How to Hardscape podcast.